Hey everybody, this is AJ again. Welcome back. I just wanted to take a couple of minutes and explain call options in a little bit more granularity. So when we talk about doing a call option, obviously that call option is a uh, contract between a buyer and a seller to buy an underlying at a specific price. But the specifics on exactly how the profit or loss is being generated over time, I think is pretty important. So let me just take a minute here and pull up. Well, don't need to have my face in the way here. All right, so buying a call is a bullish tactic, right? So we're buying a call for XYZ Corporation. So that's what everybody uses as their typical company that doesn't really exist. So what's the type of option? It's a call. The action we're going to be taking is buying. The strike price is 80. We talked about that before. The premium is $2.50. So for 100 shares, that means it's going to cost me $250, right? So over on the right, we have kind of a price chart here. The price is on the vertical axis and then the time on the horizontal axis. So let's say we have 30 days um, to expiration. What I put on here is that break-even price. So when we buy a call option, what we want to do is we want to take the premium that we paid and we add it to the strike price, and that's going to end up being our break-even price. So let's say we start out, we bought a strike at 80, the current price was at 75, and as time goes on, the price increased a little bit. So as that price increases rather kind of drastically there, what's going to happen is the value of this call that we purchased is going to increase as well as a function of delta, which is beyond the scope of this conversation, but we can talk about in the future. So as we get a little further along in time, we notice that the price ends up at this period at the strike price. So now it is an at the money option, right? So when we originally purchased this option, we were out of the money, or OTM. At this particular time, we are at the strike price. So now we are ATM. And at the strike price option has the highest amount of what's called extrinsic value with relative to the price and the time left. Extrinsic and intrinsic value are the two components of all option value. So intrinsic value is if it's over the strike price, there's some intrinsic fundamental value. So if it expired today, what would that option be worth? At the money has the highest extrinsic value, meaning the potential to be profitable. So as the price dips back down below the strike price, the call option is going to reduce in value. Now, as we're moving along in time, the call option is also going to be losing value in accordance with that theta, right? So now we pop over the strike price, and now we stop at that break-even price of 82.5. So at that break-even price is where we're going to start making money on this option. So we're just going to let it kind of move along back down to the strike price. So now we've gone from in the money to at the money. And then we pop up over that break even price. So now we're in a profitable situation with very little time to expiration. You'll see this happen very often. And then we can end it here and say, okay, we ended up or we expired well in the money at that 90 point. So we made a significant profit on this option. So I think when you visualize it this way, it makes a lot more sense, just kind of where that break even is, where that strike price is, what the underlying is with respect to the profit, and then moving it along that time axis is really critical for understanding how options work. So let's do another example of a call, and then we'll kind of wrap it up. So selling a call, right? So let me just get myself off the screen here. So selling a call is a bearish tactic, right? So you sell a call for a specific company, um, and the action is selling. We're going to sell it again at the strike price of 80. And now this premium is going to be the premium that we receive from executing or selling this this option, right? So now my break-even price is actually above the strike price because I sold that option. So I have that little buffer of money, right? So if we start out at 30 days DTE or days to expiration, let's see if I can push this along here. And so immediately what we see is as the seller of that call, the price goes back up very early on. What that's going to do is it's going to increase the value of that call. Now, as the seller, when the value of the call increases, we're actually going to be taking let's call it an unrealized loss, right? So we're going to lose a significant amount on the value of that call that we're short, right? As the price goes back down and further away from the strike price, our premium that we sold, or the value of the call that we sold, is also going to decrease. And now we're essentially at the price we started at, but we're further along in time. So everything else being equal, that means that the value of the call will have decreased because of the time value of options. So we'll just kind of run along here a little bit more. Now we're back up to the strike price. So we're now at the money, and we will most likely be in the water with respect to having sold this option at this point. We get a little bit of a reprieve, right? As the price goes down a little bit, as the seller of a call, we want price to reduce reduce or stay below the strike price. And we move forward in time and we're above the strike price again. And now we're starting to threaten our break even. Our break even is the point at which if it goes above the break even, we end up losing on the trade. As time goes on, the value of the call as the seller is going to decrease. Really, all options decrease in value, everything else being equal over time. It dips below the strike. As you get closer to expiration, these movements in price end up having a larger overall effect on the value of the option because of something called gamma, right? So this is something that's probably a little more advanced and we'll talk about in the future, but it's in a good place now. We're still below the strike price, and so we would be in a good position as the seller at this point. But like we had seen before, we started getting threatened on our break even and on our strike price. This move away again is going to have a pretty big swing in the decrease of the value of that premium or of that option. And then it's going to jump up over our break-even price. So now not only are we losing money on the option that we sold, but we are losing the premium that we made. We're all actually in the red for a loss. So as time goes on, we'll just kind of run this thing out. And then if it expires out of the money, right? So below the strike price on the call, what ends up happening here is that we end up making that premium, right? So as the seller, our max gain is going to be the premium that received. So I think what's important to understand about these calls is like kind of why we do it, and then where we're at with the time and being on either the buying side or the selling side of that option. So when you're selling that call, like I said, it's a bearish tactic. So you want the price to stay below the strike price. And certainly if the price moves away from where you started, you're in a better position anyways. As the buyer of a call, you are taking on a bullish tactic, right? So you want the price to increase. So I hope this actually explained a little bit better the kind of the fundamentals of the call options. And in a little bit, we'll talk about the put side of this transaction just to round it out and have a great understanding. Thanks, everybody.